Well, hello everyone and welcome to the last session in this webinar series, most exciting session, which is investment accounting, disclosure and reporting. Lots of fun. My name's Karen Jones. I'm a Managing Director at PFM Asset Management. I'm a CPA Australia and I'm also a Chartered Accountant for the UK. Hence the accent, I'm sure everyone has noticed. So today, let me go through what we're going to discuss. So here's the session overview. We're going to look at the accounting standards, FASB and GASB, and I'll explain why I'm going to do that in a minute. We'll have a look at the methods of accounting, and then we're going to touch on GASB 31, 72 and 40 and what those different requirements are. So let's have a look at the two accounting standards in the US. So in the USA, there are two main standard setters for generally accepted accounting principles. There's the Financial Accounting Standards Board, known as FASB, and then there's the Governmental Accounting Standards Board, GASB. Most of you are going to be very familiar with GASB, and you're probably sitting there saying, why do I really need to know about FASB? Well, it's really important for you to know that there are the two standard setters because GASB follows FASB typically. There are little nuances for government accounting, but for example, FASB launched fair value accounting quite a few years before GASB did. And GASB often refers to standards in FASB when it hasn't fully developed its own thinking on something. It refers you back to FASB. So the FASB, basically think of the FASB as establishing the accounting and reporting standards for public and private companies. So these are your SEC registrants. These are your private companies as well, perhaps your mum and pop stores who wants to use accounting standards. And then, of course, we've got GASB, which I know everyone on this call is going to be familiar with. So let's now go to the methods of accounting. So we have historical cost. Really easy concept. You buy something for $10, stays on your books for $10, never moves. May have dropped in value if you sold it. You may not be able to get $10, but it's going to stay on your books at $10. We have book value. Often this is called amortized cost. So this is where you have a security, it has interest or it has a discount. You're going to write up that discount, and I'll give you an example of this. You're going to write up that discount to come to the actual par value of the security by the time it matures. Then and those two ways of valuing in accounting have been around forever. A few years ago, it's around 2006, 2007. The FASB and the International Accounting Standards actually started talking about fair value accounting. I can tell you at the time, this caused a lot of concern amongst companies. Lots and lots of people were concerned about the volatility of the financial statements, etc. We'll get into that a little bit later. But just so you know, there was a lot of concern and now, at the time, but now it's sort of, oh yeah, we fair value our investments. So basically fair value is the price that would be received to sell an asset or transfer a liability in an orderly transaction between participants at measurement date. It's an orderly transaction. It's market participants at the measurement date, and they're key for you to remember when you're looking at fair value. Let's go a bit more into what fair value means. So some of you, if you have a 401k or something like that, You've probably heard of the term mark to market. That's what fair value is often called, because you're actually valuing your portfolio at what the market is measuring as that day. So let's think about GE stock in 2007. GE stock, prior to the meltdown at the end of 2007, 2008, was something in the region of $40 odd a share. Afterwards, I think it was beginning of 2008, that dropped because of the financial crisis to $5 a share. So you saw all these people take these huge losses on their portfolio, because fair value does that. It uses the current market value to recognise what the value should be on the book. It recognises those market fluctuations. I'm sure, if all of you were watching your 401ks between 2007 and 2009, probably most of you, including me, sort of just shut their eyes and didn't want to know about it, because it was so volatile at the time. Where's the fair value recorded? Well, because we're GASB and not FASB, we're going to be recording the changes in that fair value, so the difference between the $40 to the $5, we're going to put that in our income statement as either revenue or it's going to be a loss. Just down the bottom here, I think you can see my pointer, I've actually given you the various standards for FASB and GASB. So let's have a look at perhaps what the impact is on a discount security. So here we've got the Bank of Tokyo commercial paper, $1 million. That's the par. That's at the end of when it matures, you're actually going to get $1 million back, ignoring the interest at the moment. But you buy it from someone or the market at a discount. You only pay $998,000 for it. So you've got that as a discount. When it does mature, you're still going to get the $1 million. So that discount on the purchase is $1,424. And I'm giving you these numbers. Please don't try and calculate them because you just don't have enough information. So the amortized cost as at August 31st is $998,751. The fair value is $998,620. Well, that's interesting. They're not the same. So what are we going to do? So let's go to the next slide. If we were doing book value amortized cost, we're going to have to write the discount up. We're recording the discount, not the income at the moment. So you're going to do 175. You're going to write up the investment here, and you're going to have 175 in investment income. Here I put a note. GASB and FASB records the discount in a similar fashion. Okay, so that's book value. If we were doing fair value, we obviously do our initial recording. We say the fair value is what we bought it from, the person selling it. But as you recall, the fair value wasn't the same as the amortized cost. There was a difference in what we purchased it for and what it's now valued at of about $44. We have to recognise that in fair value. $44 investment. Change in the fair value is recorded as investment income. So one of the things now, GAS 31 and 72 are really your standards for fair value. That's why I'm discussing those today. Do you have to separate the interest income and the gains and losses in fair value? Nope, you don't. Can you record the realised and unrealised gains separately? No, you can't. But you can disclose it. That's permissible, but you cannot, on your income statement, you're not permitted to do that. Let's go to the next slide. Now we'll go into a bit more depth about GASB 31. This is and many of you would have already used this. This is accounting and financial reporting for certain investments and for external investment pools. So, when we have investments as a government entity, how do we need to record those? So 31 is applicable to all investments held by government external investment pools, and it establishes fair value standards for investments that have readily determinable fair values. Now, the definition of investment is quite specific. Your investments that are held primarily for the purpose of income or profit will fall under this definition, and you are required to fair value them. Many of the larger government bodies do fair value on monthly, quarterly basis. Some of the smaller municipalities often record everything at amortised costs throughout the year, and then they do a true-up at the end of the year to recognise fair value. But everyone has to record their investments at fair value. As I just said, the investments meeting this definition are required to be reported at fair value. Are there any exceptions to this? Of course, there's always exceptions, isn't there? So certain short-term debt investments, you can hold those at amortised cost. Short-term is less than a year, sort of like your current things. Non-participating interest-earning contracts can also be carried at cost. Now, that's where you've got the bridges and you get a share of the tolls, that sort of thing. External investment pools are allowed to be reported in certain money market investments at amortised cost. Again, I would encourage you to go back to the standard and make sure that you're not claiming an exception when you shouldn't, because there's very few. The other thing that this is where it varies from the FASB requirement, because all of your unrealised gains, losses are going to go into the income statement. In FASB, it's a little bit different. It depends on how you classify your investment. You don't get that opportunity in GASB. They say all investments must be held at a fair value, and all unrealised gains and losses have to be recorded on the face of the income statement. So let me summarise that. It clarifies the meaning of an investment as a security or other asset that a government holds primarily for the purpose of income and profit. It also has a present service capacity based solely on its ability to generate cash. As I said earlier, all investment income, including changes in fair value of investments, have to be reported on your operating statement. And just reiterating what I said before, you can't separate realised and unrealised gains in the financial statements, but you are permitted to disclose it. I think probably you would disclose it if you've got a lot of volatility in the market. Again, remember, and this will be a theme throughout this seminar, disclosure, the reason for disclosure is to inform the reader, give the reader information upon which they can make a decision. So if your disclosure, if you read your disclosure and you think, that's not going to help anyone make a decision, don't put it in, because that's the only reason for disclosure, to help the person reading the financial statements have a better understanding of what's going on and on which to make decisions. Always bring it back to that. Always when you write a disclosure, bring it back to decision making. Will this help the person reading it? When this came out, as I said, it was a lot of consternation about fair value. Also with private SEC registrants as well. I can remember sitting on an accounting policy board with accounting policy people from Goldman Sachs and accounting policy people from Bank of America. Bank of America wanted to keep amortized costs. Goldman Sachs wanted everything at fair value. So even within organisations like that, there was still this disconnect when fair value came out. Certain investments, as I said, are not reported at fair value, and we've got them all outlined there. So many of you, and I wanted to address investments in a local government pool, particularly for fair value. This is, you've got a government investment in LAIF or CAMP or a county pool, that's got to be fair valued. Well, as you know, you're only one part of that pool. It's a huge pool, but you're only a small part. How do I put the fair value on my books? Well, it has to be a proportionate assignment. And here I'm giving you an example of how to do it. So let's say you will take, to calculate your proportion and your fair value, you're going to take your fair value number here, okay? That's it up there. You're going to divide it by the cost. That's down here. You come up with that number. Let's say you had 10 million in this pool. It's 10 million by the cost, the ratio here. That's your fair value. That's how you get it. Let's now go to GAS 72. I'm hoping I didn't go too fast for you there, but 31 and 72 really go hand in hand with each other. 72 gave us more information on how to measure fair value, different methodologies, etc. Also, some of the disclosures that you will be required to put in your financials. So GAS 72 is a three-part statement. It talks about measurement. How do we measure something? What is fair value? Where do I go for it? Well, I know I can go on the New York Stock Exchange for things like GE. What if I've got something that isn't listed on the stock exchange? What if I'm given, say, some art from a benefactor? How do I fair value that? So these are all the sorts of questions that you will come across in your daily duties when you are fair valuing. Talks about application. What should be fair valued? And we've really gone over that previously, but I'll just reiterate it again because it's very important. Then I'm going to look at the disclosures. So as I said earlier, what is fair value? Well, it's the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. That's a real mouthful. But what I want you to really focus in on here is price, orderly transaction. Why is that important? Because an orderly transaction assumes it's not someone that's doing a fire sale. What you pay for something in a fire sale is not necessarily, it's not an orderly transaction, so you can't apply this. So you have to really think about that. It's between market participants. Now, as I said, if you go on the New York Stock Exchange, it's very easy to get the price, etc. So it's the New York Stock Exchange has the scope and breadth. It's the biggest in the world. So you can pretty much say that's got all the necessary characteristics of a good price. But there's also market participants. So perhaps something's not listed on the exchange. You have to think about who your market participants are. Would it be another investment company? Could it, if you're selling a banner, you know, a name brand or something, you know, what you are. So, for example, Macy's in California, in Chicago, owned a particular department store, and it had a brand name, and they said they couldn't value it, but the auditors actually made them value it. They said, yes, there are market participants, and these are the types of market participants you would look at. It's also measurement date. It's not 2 weeks earlier, it's not 2 weeks later, it's measurement date. It's the day that you're actually going to put it on books. Can I adjust the price for anything? What if I've got a shareholding that is, if I sold it, let's talk about Amazon. So if Jeff Bezos sold his shareholding, he's likely to destroy the market, right? You know, if he dumped all his stock of Amazon onto the market, you would see the price starting to come down because the availability of that stock becomes more and more as he keeps dumping stock. That's called a block discount. You're not allowed to take block discounts. That is not included in the fair value. It's not adjusted for transaction costs. It's also got to be in your most advantageous, your principal or your most advantageous market. So most of you know that stocks can be listed on both the New York Stock Exchange and the London Stock Exchange. However, if you're in California, you can't, even if, say, the London Stock Exchange is showing a higher price for the investment you have, that is not your principal market. Might be your most advantageous, but it's not your principal market. And auditors tend to defer to the principal market that you're in. So please, no, don't go over to the London Stock Exchange just because the price is higher. Market participants, why is that important? Well, it's what they pay. It doesn't matter what I think they should pay. It's the people who are willing to buy the asset from me. And then we talked a little bit about measurement date, not necessarily the financial statement date. So again, we have to remember all of that when we're using measurement for fair value. So what are the different valuation techniques? There's something called the market approach. This is the easiest, and I am going to assume that most of you here are going to be using the market approach. And the reason I say that is because with your investments, your investment policies don't let you go out and buy, really don't let you go out and buy things that are not listed, that you're not speculative in nature. You have a fiduciary responsibility to the taxpayers of the county, the municipality, etc. So the market approach, it uses prices, often listed on the New York Stock Exchange. It's generated by market transactions involved in identical or similar assets. Now, those two words are very important when we come to record the level of the fair value a bit later, and we'll talk about that. Now, again, these other two approaches are unlikely to apply to your investments, but for completeness, I'm just going to briefly discuss them. So then there's the replacement, the cost approach. So what does it cost to replace a service? What does it cost to replace an asset? This is often what manufacturing companies would use because some of their equipment is so unique. There's not a market out there for it, so they have to use the cost approach. The income approach, this is one I'm sure all of you are familiar with. This uses net present value, option pricing models, some of the Black-Scholes models that some of you would be familiar with. Again, it's not an approach that many of you will use because of your investment policies being prevented from doing so because of your fiduciary relationship with the taxpayers of the particular county. Risk adjustments. You can include a risk premium or discount that market participants would demand as compensation. So some things, you do have to reflect that. And again, reflects an orderly transaction. Application of fair value. I keep going back to this definition because it's very important. It's a security or other asset that the government, that your counties, municipalities, states hold primarily for the purpose of income or profit. It is not assets that you might hold as part of your mission, and I'll go into that in a short while. The key here, held primarily for income or profit. If you're holding an asset that's being held to further some part of the mission of the local government, to provide a service, you're not required to report that at fair value. So some of you may have public housing. You might have found that's really going up in price, particularly in California. New York's the same, by the way. We have some public housing along the river there in New York, and that's quite valuable. But again, you don't have to report that at fair value because that's not the primary purpose. The primary purpose of the housing is to provide housing to the underserved, underprivileged. This is quite interesting here, this bullet point here. If you change the usage later, you're not going to change the initial determination as to whether that asset will be reported at fair value. Again, most of you are going to have investments. They're going to have QSIPs, etc., etc. But this is just for completeness. I'd like to go through just a very quick example. Again, this is in the standard. So let's say a city government constructs an office building. They fully intend to occupy the building for a city program. But while the city's waiting grant approval, etc., the city's going to lease that building and receives lease income. Is that going to be an investment that needs to be classified at fair value? No, it is not, because that was not the primary purpose when we initially entered into the lease. That's not what we signed up for. We're going to use that office for a city program, so it doesn't fall under 72. And there's another example there, but I'll let you read those later. Okay, earlier on I talked about what if you get some artwork? Are you required to fair value that? And I can't go and look on the New York Stock Exchange for that. Well, yes, you are required to fair value that if that's going to be producing income for you. You do it at your acquisition value. You can see donated capital assets, works of art, historical treasures, and capital assets received through a service concession arrangement. So just be aware of those. Probably there's not going to be too many that you're going to have for generating income. So that's sort of fair value, what you fair value, different methods. We then have to disclose, when we talked about where you get the fair value from, etc., they're then actually put into levels. We level those fair values into level 1, level 2, and level 3. So level 1 is quoted prices in active markets for identical assets or liabilities. I keep saying liabilities here, but I don't believe many people do fair value their liabilities. You can get some very strange results if you think about it, if you fair value a liability, particularly if your credit rating goes down, because you might have got it at, say, 2%, but if your credit rating reduces to junk bond status, you might have to pay 10%. Well, now you owe less if we fair value. So it can produce some very strange results. So level 1 is quoted prices in active markets for identical assets. Your active market is New York Stock Exchange. That is, as I said, the biggest in the world, breadth and scope, all that sort of thing. The other thing that's interesting about a level 1 asset, it's an identical asset. It's not similar. It's not looks like. It's identical. And if you are getting a price of an asset that looks like it, then you cannot put it in level 1. And I'll explain, often you'll need to talk, if you think you have something at level 1, I encourage you to talk to your auditors, really, because different firms have different understandings of what they will accept as level 1. For example, I used to write the fair value disclosure for GE Capital. I used to have treasuries in level 1. I was told by my auditors, one of the big 4, I was not permitted to use treasuries at level 1 because they weren't identical. So I had to put on level 2. If you now go and have a look at many companies that are listed on the exchange, you will find that there is this big glut of fair value in the hierarchy of level 2, because level 1 is almost non-existent. So level 2 is quoted prices for similar assets, and level 3 are unobservable inputs. I would be so surprised if any of you had level 3 assets in California. Really surprised, because these are where you cannot go to an external source. You have to use net present value models to actually value the asset. And most investment policies I've seen, plus the state, will not allow you to have those types of investments. So, but you do have to be aware of it. Let's have a look at some common classifications. As I said, should be rare. So level 2, some auditors are going to make you put treasuries in level 2. So do be aware of that. Probably wouldn't argue with them if they tell you to put it in level 2. Okay, note disclosures. You have to organise it by type or class of asset, information on each class, and the fair value measurement categorised. Let's have a look at this. This is an example of how you could possibly do this. Again, this particular example has treasury notes in level 1. If you had my auditors at GE Capital, they would not allow you to do that. You would have to put that in level 2. So again, please refer to your auditors. Again, another example of investments measured at NAV, how you'd possibly disclose those. Again, it's all about disclosure. Remember what I said at the beginning. Go back when you're writing these disclosures. Try not to just copy and paste. Have a think about, does this add value? Does this give the reader information that they would not have? Information that they would not have and that is valuable to make a decision. And this is just some optional narrative format. Most things I've seen are actually in the tabular format. You might find it a little easier to do. It's also probably easier for the reader or the user of financial statements to look at. Okay, let's get to the really fun standard now, GASB 40. So, GASB 40, it's only a disclosure standard, not a measurement, nothing else, just disclosure. Really important though, particularly for us because of our fiduciary nature with the taxpayers. So it became effective June 15th, 2004. As I said, primarily addresses disclosure. It's really to inform the reader about certain risks that are associated with an entity's investment portfolio that are not otherwise apparent. Again, what we're trying to do here is explain to the reader of the financial statements how we are looking after their money, how we are looking after the taxpayers' money. Really important. I mean, private companies, SEC registrants, they have to be mindful of their shareholders. However, we have a much more, as guardians of public funds, we have a much higher standard to meet. So it's very important that we explain to our readers what we're doing with their money. So GASB 40, it addresses 4 main sections: credit risk, the concentration of credit risk, interest rate risk, foreign currency risk. So they're the sorts of disclosures that you're going to have to do. Okay? It also requires, if you've got any of those risks that you have to disclose, it also requires you to describe the deposit and investment policies that are related to those risks. So, for example, if you've got an investment that's denominated in foreign currency, you have to disclose your foreign currency investment policy and how you manage the risk for that. So as I said, credit risk is the risk that the issuer will not fulfill its obligation. You also have to disclose any state laws or policy requirements associated with that risk. That's the one I just talked about with the foreign exchange risk. And there's no minimum. If there's no requirement for a minimum rating, you need to state that as well. What's interesting here is that US government obligations and obligations that the US government explicitly guarantee, that's very important, it has to be explicit, are not considered to have credit risk, so you're not required to disclose that. So how do we disclose credit risk? Well, you group the investment types. We'll go through some examples. You can give a range of ratings associated with those investments. You're not required to actually put whether it's AA1, AA2, AA3. So they're like credit quality modifiers. You just put AA, AAA, etc. You only need to disclose the ratings at the end of the year. You're also required to disclose federal agency securities. So their federal agencies need to disclose those. You need to disclose the credit quality ratings of external investment pools, money market funds, bond mutual funds, other pooled investments of fixed securities. You also need to identify and disclose any investments that are unrated. I would also always encourage you to retain all of the backup documentation, etc., on how you arrived at these disclosures for the auditor to review, because they will ask to review them. Now, here is just a Q&A that GASB's put out. I won't go through that. I know I'm going to go over time, so I'll try and hurry up a little bit. So, all GASB 40 disclosures must be broken down at least by investment type. For example, treasuries, corporate bonds, you're not permitted to aggregate dissimilar investments. So, for example, US T-bills and US Treasury strips, can't aggregate those. For GASB 40 disclosure purposes, an investment in an external investment pool is a single investment. Disclosures in 40 are made for primarily the government, the main government, not for the subset. However, if a subset has a risk that's significantly greater than the blended government, then you should actually disclose this separately. Again, come back to what do we think the reader needs to know? What is important for this reader to know? What are the purposes of this disclosure? Then you have to do concentration of credit risk. So any one issuer that represents 5% or more of the entity's portfolio. You can exclude government assets, mutual funds and external investment pools. Okay, custodial credit risk. This is for your deposits. It's basically how deposits are held. Deposits are exposed to custodial credit risk if they're not covered by depository insurance, the FDIC. Any deposits exposed to custodial risk need to be disclosed, identifying the amount and the fact that they're uninsured. If a bank account is not collateralized, you need to disclose the dollar amounts in excess of FDIC insurance limits, only the excess. And again, retain evidence for your auditors. Also be careful about how things are collateralized, because if something's collateralized, but it's held by the pledging institution, you need to disclose that. If it's collateralized and it's held by a trust department of the pledging institution and it's not held in the government's name, you also have to disclose that. Let's talk about custodial credit risk for investments. Obviously, you only do this on an exception basis. It typically are investments that are exposed to custodial credit risk if the securities are uninsured, not held in the name of the government, and are held by a counterparty. It generally exists if they're being held by the broker or dealer. It does not include, the disclosure you're not required to disclose where you have an investment in an external investment pool and money market mutual fund. Foreign currency risk, try not to spend too much time on this because I doubt most of you have it. But if you've got a foreign currency held denominated investment, you need to disclose that, and you need to disclose your policy as well, remember. Okay, let's have a look at interest rate risk. This is the risk that changes in interest rates demanded by the market will adversely affect the fair value of an investment. Remember that thing we talked about earlier about fair value? And you can use 5 methods. And I'll briefly go through the 5 methods. Specific identification. This gives a list of each investment, its amount, maturity date. Segmented time distribution, tabular form, investment cash flows into sequential time periods. Weighted average maturity, this is the investment time horizon, weighted to reflect the dollar size. Simulation model, estimate changes in fair value given hypothetical changes in interest rates. Don't worry, the last 2 I'm telling you not to use unless that's how you manage your interest rate. And duration, measure exposure fair value changes arises from changes in interest rates. The methodology that you choose actually needs to be consistent with how you manage your interest rate. So don't pick a simulation model if you really don't manage your interest rate like that. You can use different methodologies for short-term versus long-term portfolios. Again, disclosure assumptions that you make. Disclosure is your friend. Similar investments can be aggregated. Okay, so here is the specific identification. Here we've got the S&P rating, par value, maturity rate, market value, and what's the percentage of the portfolio. This is a nice, easy one, really easy to understand. I think most of you probably use this method. This is the segmented time distribution. So as you can see, it actually breaks up your investment maturity into the different time periods, less than a year, 1 to 5 years, gives you the fair value. This can also provide the reader with some very interesting information, because if interest rates, if you've got a large percentage of your investments in this section here, more than 10 years, and you know interest rates are volatile at the moment, perhaps you're not doing everything that you should to mitigate that risk. So this does inform the reader of those sorts of things. Okay, this is the weighted average maturity. This is very useful for eggheads like me. I really like this. However, think of what your purpose of your financials are. Who is the audience? Not everyone's going to have CPA and everything like that. So do think about that as well. And again, how you manage your interest rate risk. If you manage it this way, well then, yes, that's how you'll have to disclose it. Simulation model, I would suggest not to use this unless this is how you monitor your risk rate, your interest rate risk in your portfolio. And then duration. Again, I would not recommend that you use this unless that is the way you monitor your portfolio. And here I'm showing you duration, just as an example, just so you can see how you would perhaps disclose it if you had to. Then we have some highly sensitive investments. You're going to have to disclose those as well. And on this page, I'm giving you some examples of those investments. I won't go through most of those. If any of you have questions, we can discuss them at the fireside chat that we have later. And again, retain all the documentation for your auditors. Really important. It's going to make your life so much easier if you've got that documentation. Okay, this is where I said earlier on, you've got to, if you are disclosing something, one of the credit risk or credit concentration, You also have to disclose information about your policy to manage that risk. Very, very important. I hope you've got some insight into the three standards, and also the fact that you also probably need to know a little bit about FASB even though you're using GASB. I hope you've enjoyed it. Thank you so much.